Welcome back to another video, and in today's video I do want to give you guys the usual market breakdown, weekly market breakdown. We are going to take a look at the dollar index as well as gold, Nasdaq, GU, EU, as well as the US 30 and the S&P 500. Now, if you are new to the channel, a sub would be appreciated as I provide valuable educational content on a daily basis. And if you enjoy the video, please smash the thumbs up for the YouTube algorithm there as well. And don't forget about the promo where you sign up for the signal services. If you do sign up, for the 2 months, you will get access to the high risk and low risk group until the end of the year there as well. Low risk group is more for funded people with funded accounts. The high risk group is not high risk, but it's basically where I send more signals out there on a daily basis as well. Now, in any case, let's just go straight into the data. Now, it's important to understand that next week we've got the most important news coming through, which is the interest rate decision. We also have NFP pulling through very sharply there as well. But it's very important to understand where we've been and what could possibly implicate these decisions coming into next week. Now, it is forecasted that the Fed is going to hike interest rates by a 0.75 basis point, and it's very clear that with this report that we received over here from CNBC, it says here inflation remains persistently high at a 8.2%, and that basically we can see here that it says that the rate of inflation rose by 0.4% in September and remains well above its benchmark target of 2%, making the prospect continued jumbo interest rate hikes more likely. It says here the year-over-year inflation is now at 8.2%, down from 8.3% in August, according to the Labor Department Consumer Price Index. However, it is not exactly where the Feds needed to be, meaning that we can expect another interest rate to pull through, and that is expected at another 0.5 basis point, taking us from 3.25% all the way to 4%. And how that is going to impact the economy is exactly what I want you to take a look at very shortly. We also got the NFP data coming through, is expected to be lower. I do expect it to come through lower as well, because we have had some very negative data. We had some very bad earning reports, and we can see over here this article from CNBC says that other than Apple, it was a brutal earning weeks for big tech stock companies. Alphabet, Amazon, Meta, Microsoft combined lost over 350 billion in market cap, offering concerning commentary for third quarter remaining of the year. It was also reported that Google, or I think it was Google, is looking at cutting their employees for quarter four there as well. So you can see things are not looking good for these companies there as well. And these are companies that is normally good for job creation, and they were all impacted negatively at the end of the day as well. So it's very bad to see, but at the end of the day, this is exactly what inflation does. Now, if you look at this information and you kind of look at the fact that we are going to get some interest rate hikes coming through there as well, based on this article, it talks about jumbo rates. There is a high probability that the Fed is going to hike interest rates by a 0.75 there as well. We can also expect the job reports to potentially come through lower, and we can expect unemployment to increase as the result of that as well, ultimately giving the dollar the strength that it requires, because with higher interest rates comes a stronger dollar. And Fed had said this, Jerome Powell had mentioned many times in the past when he testified in front of Congress that a lot of people are going to lose their jobs because they need to bring down inflation. Now that we get that out of the way, the next thing I do want to point out very quickly is you can see over here that the current inflation for the US is sitting at 8.2% for the 12 months ending September 2022, after rising 8.3% previously. And that is according to the US Labor Department data. Now, the next thing I want to bring your attention to very quickly, this is basically how the interest rates were hiked since 2020 all the way to 2022. Now, if you take a good look at the dollar index, for instance, if you see this year basically. Okay, so for this part of 2022, and you can see this was within the third month that we came through here. This was somewhere around yeah, and you can see what had happened here. So ever since 2020, sorry, ever since 2021, we had this massive bull run, and you can see here how the Feds came through since 2020, how the Feds went from having a 0% interest rate to 0.25 to 0.75 to a 1.5 to a 2.25, now sitting at 3.25%. And you can see how the interest rate had given the dollar index the strength that it requires. And if you look at the stock market, for instance, let me just remove this. If you look at the stock market, for instance, this is basically what happens over here. And you can see that we were sitting somewhere around here when we were at a 0% interest rate, right? And just to give you a peace of mind very quickly, so here this is where we were at. So from 2022 up until since 2020, and you can see ever since 2022, this is basically where we came in here this year. This is when we came through in 2022, and the Fed started hiking the interest rates over here. Now you can see every time the Feds hiked the interest rates, the market took a little dip, and it is expected that the Feds are going to hike the interest rate once again. And you can see this with gold as well, because gold has got a negative correlation with the dollar index. And you can see over here also, if you go back to 2022, you will see that the market had started to fall since the Fed started. There you can see 2020, 2022, and then boom. Okay, so the fact that we do expect the Feds to come through this week and hike their interest rates is giving us an indication that we can expect the dollar now to continue the bull run to the upside as we anticipated. Now, if you look at the dollar index, if you start on the monthly time frame, firstly, you can see the market had broken below the strong level of support, came back to test it as resistance. The market also broke above this very strong level of support, came back to test it as resistance, broke above resistance, came back to test it as support, confirming that move to the upside once again for the market to go and test that previous level of resistance there once again. If you start on the month, if you look at the weekly time frame, you can see the market came to test this level. Now, if you remember on the last breakdown, I said exactly we can expect the market to come and test this level over here before that continuation to the upside, and that is exactly what the market had given us. We also had this massive impulse. We got that correction, confirming that continuation to the upside once again on the daily time frame. What do we have? Now, from a daily perspective, it's quite clear that that the market had printed this low over here, probably obviously coming through and giving retail traders that confirmation that they were looking for that short-term sell. But like I said, we can expect the market to complete this information at the neckline once again. But because we do have a weekly time frame bias where the market is currently trading in bullish territory, we do expect the market to continue higher from that perspective there as well. Now, the best way to approach this is obviously we have to be reactive and not predictive, and this is a very strong structural level. Going into next week, I do expect the dollar to continue higher, and then I'll give you guys an update once we get to this level here as well. However, depending on the kind of structure that the market does create, I do expect the dollar to continue higher. Gold, on the other hand, if you remember, I made a breakdown, the last one when the market was sitting at that level, explaining all of the reasons for that move to the downside. Now we can expect the market to continue lower here as well. We do have a potential inverted head and shoulders pattern, but because the bias is bearish on gold, the best way to approach this is obviously to make sure that we trade in bearish territory, is to wait for a clear break below this level on the retest. We can definitely expect that continuation to the downside there once again. If you look at the Nasdaq 100, the Nasdaq has been quite bullish over here, and at the open of Monday, because of the negative data that we have received for the stock market, I do now see the U-turn start. So I do expect going into next week for the stock market just to make a U-turn and potentially start this consolidation phase over here as well. US 30 also, if you remember, I said we can expect the US 30 to go higher when I when I did that US 30 strategy that I did, and we can see the market is now also on the monthly time frame. The market is now coming back to test that level of resistance, and if you check on the weekly time frame, you can also see how the market is currently testing broken support now as resistance, and yeah, on the daily time frame, we also have the market testing this previous level over here. Now, I would say that going into next week, we have broken above very strong resistance, but I do expect the market now to give us a pullback because you have this massive impulse. After an impulse, you do expect a 50% pullback, and if you take your Fibonacci from the low to the high, we do now see that we have got the 78.6 lining up with that structural level over there. Now, going into next week, well, what I would say, I do maybe just maybe expect some clearance to the upside. Alternatively, I do see the market continue lower from exactly where it is now, as I expect whatever drove the prices this high to not be standing in the way once again. Next up, we've got the S&P 500, and I do expect the S&P 500 as well just to slow a little down and then give us a pullback as well. So I do expect the S&P 500 once again to pull back. We do have all of that data to pull through as well. Now, sorry about that, my good friends. Next up, we do have GBP USD. Now, I have spoken about this. Sorry about that, guys. So I've spoken about this pair before there as well. Now, if you start here on the monthly time frame, what do we have now? From a monthly perspective, it's very clear that we had a market that broke below a very strong level of very strong level of support. We obviously expect this. We would have expected this market to continue higher. Now, there is a possibility that we could still see that. However, on the weekly time frame, we are testing strong weekly resistance. We also have this W formation. After W formation, you do expect a pullback to the neckline before that continuation to the upside. What that means is I do see a pullback in the GBP USD going into next week for the market to go and test this neckline of this W formation on the daily time frame. What do we have? Now, here from a daily perspective, it's clear that we do have a market testing previous level of resistance and a previous level of support. And the best way to approach this is obviously to wait for a clear break below this level on the retest. We can start looking for that continuation to the downside for the market to go and test that neckline on that neckline of the W formation that's we identified from a weekly perspective. Next up, we do have Euro USD. Euro USD, you can see, has been quite bearish because of the interest rates that we had that came through on Friday. Now, because the Euro USD had broken above this level of resistance, broken above that, support did not hold, we do expect Euro USD just to give up everything that it has currently and just continue this move to the downside going into next week there as well. Also, for the market to complete this potential overextended W formation to the neckline after it failed to retest the left leg there as well. Thank you for your time, and as always, cheers for the ears.